Hey everybody, Happy New Year. I guess it's not quite New Year's yet, but this is the final managing an options portfolio of 2025. I'm glad you're here. Good to finish off the year with you. And today I want to talk about risk and rolling and just stuff related to managing an options portfolio. Hopefully it will benefit you in your portfolio as we look to 2026 and managing that. I'm joined alongside Ben Watson in the chat. I joined Ben this morning on Trader Talks. It's always a great experience being with Ben. I learn a lot. I've learned a lot from Ben over the last over 2 decades we've been working together now. And many of you know Ben if you've been to one of our workshops. I encourage you to check him out if we do have a workshop in your area. And also check out some of his other webcasts, including Trading Index Options, which occurs later today. And so I appreciate Ben. Hey, you can follow us on X at Brentmore CS, at Ben Watson CS. Let's hit up the disclosures before we get too far into this, though. Options do carry a high level of risk and are not suitable for all investors. Multiple leg option strategies will involve multiple transaction costs. Short options can be assigned at any time up to expiration, regardless of the in-the-money amount. Rolling strategies can entail additional transaction costs, including multiple contract fees, which may impact any potential return. The material today is intended for educational and informational purposes only. Paper Money software application is provided for educational purposes only. And it does not assign short options early. I'm not going to factor in commissions in the trades we do today, but just consider that it is something to consider. Schwab does not recommend the use of technical analysis as a sole means of investment research. And all investing involves risk, including loss of principal. Past performance is no guarantee of future results. Happy New Year to each of you. Let's head on over to the Thinkorswim platform. This is the S&P 500. We have finished the year. We're finishing the year off. Market's hasn't closed yet. A little loss so far today. I don't know if we'll recover by the end of the day, but all in all, we're up around 16, 17%, I think, for the year. Not a bad year in retrospect. We've had some ups and downs throughout the year. And in fact, if I go to a year chart, you can see we did have a pretty significant drop there, February to April. See if we can get, I got the wrong tool up. Let me see if I can get that was roughly a 20% drop basically earlier this year. So, but we recovered. And the trend has been pretty strong of late. For your reference, I have a 20 and a 50-day moving average. Right now, we're still above that 20-day moving average, even though we're kind of limping into the new year. So we'll see how the next year goes. But what I want to talk about today is rolling strategies. And I want you to consider the risks when you roll, because there are risks. When you roll, you're closing out a particular position and you're opening up a new position. First thing, and I mentioned this in the disclosures, it doesn't save you on commissions. You still got to pay commissions, even if it's on one order ticket. But let's go here, and I want to just kind of go through some of these. I'm going to go to some short verticals that we have. I have BMY. I've got a short vertical on this. We're actually doing fairly well on this. We've made most of what we can make on it at this point. You don't have to roll out both legs, but I'm actually going to roll out both legs on this one here. We've got 16 days to go, and you can say, hey, Brent, you still have time. You haven't achieved 100%, a profit on this. You haven't made everything you can make on this. But here's the thing. Often what I'll do is I'll look at the trade, and I'll look at the current price on that trade. Let's look at the current price, current mark on this trade. The difference between our strikes, about 5 cents, 0.05. So what's my potential reward if I hold on to this trade? My potential reward if I hold on to this trade is that. the difference in it. The best this can do is on a short vertical is go to zero. Okay. The best it can do is go to zero. Well, $5. Is it worth holding on for 16 days for $5? Now, granted, it's $10 because we got 2 contracts here, but is that worth it? Well, maybe, maybe not. I'll let you make that calculation for yourself. But we have 2 choices. One, we could say, I'm just going to get out of this trade. Or 2, I could say, do I still like this trade? Is this still something I want to continue? And if so, maybe we just roll it. Well, let's look at BMY. This is a short put vertical. We're selling the 49 put, the higher strike put. We sold the 49 put, the higher strike put. We bought the lower strike put. That's a bullish trade. We want the stock to stay above 49. And so I'm going to do some technical analysis. Not the only way to do things. Let's go to BMY. But it is a way of doing things. And here's what I see on the chart. You can disagree. This is a technical analysis we're doing. The trend has been up. We've had higher highs, higher lows. I don't see any sign of a broken trend at this point. Yes, we've taken a little dip down, but look, we took a dip down there, we took a dip down there. It looks like it's just kind of flagging. Perhaps a new support level establishing itself right around that $54 mark. Our strikes right now our short strike was down at 49. You can see why this trade has been doing pretty well. Our short strike is way down here. It seems like a pretty big long shot for the stock to go below that level. Of course, you never know. Okay, so here we go. Now, what if we roll it up to a level that's not like extremely tight, but something that recognizes that we have a support level up here, that the trend has been going up, and maybe it can give us a little bit of a credit along the way. Well, one way to do this is I can look at, see what strikes. Well, let's do this. Let's say I want to roll it. Let me highlight these. You can click on them and then hold down your control key and click on both of those. You can right click on it. You can create a rolling order, and it's going to say sell vertical roll. Okay, that's just what the words are. I'm going to click on that. Now, it is automatically going to put me out a week, and that seems reasonable. We're expiring in 16 days right now. This would make it expiring 23 days. Okay, give us a little more time. Now, what it's doing is it is giving me basically no credit here because these are almost worthless at this point. And after you factor in spread, slippage type stuff, it's really not doing anything. But I'm going to move this up a little bit. Now, what strike should I move it up to? You can use technical analysis to do that, to look at support levels and stuff. You can also use probabilities. And you can say, well, I want to see, we're going to look at 23 days to go. Let me look at my puts and let me look at my delta on those puts. And I could roll it to like a 25 delta or a 35 delta at this point. 35 delta, lower probability of success, but more premium. 25 delta, higher probability of success, but lower premium. So you can, once you know that, you can make your own choice on that. So I'm going to roll this up here. I'm going to change these strikes, and we're going to look for a credit here. So I'm going to go up, and I'm going to make this one a 52. I'm going to make this one a 50. Now, I could keep it as a 47 if I wanted to, and my credit would probably be higher. Let me just do 50 and see what it says. Yeah, my credit would be higher if I leave this at a 47. But do you see the pros and cons of this? If I do leave this at a 47 strike, I have a $5 width spread at that point between those two. More credit, there's pros and cons. The $5 width spread means there's more risk on the trade. Well, I'm trying to balance the risk and the reward. Okay. So if I go here, let me get rid of my drawing tool. I'm going to make this a 50. Okay. Oh, 50. This would be rolling it out 1 week in the future. It'd be bringing in a $27 credit. And there we go. Now, I can play with it. This was going to be the 35 delta for the short leg. Let's keep it too wide here, 51. That's going to give me a $45 credit. $45 credit isn't huge, but hey, we've got 2 contracts, so that'd be like 90 bucks. And this is a lower price stock, and so lower strikes, just realistically, you're just not going to get that much. So if I wanted to do, I could roll that out. That's a straight vertical roll out on this, out and up, bringing in a credit along the way. I'm going to go off the mid price just a little bit to see that we can get filled on that. And I'm going to roll that. There we go. We rolled that out going into the future. Now, Mary said, would you want to delay the gain and push it for tax recognitions? I can't for tax purposes. Hey, end of the year, a lot of people are doing trades based on their particular tax situation. I'm not allowed to speak to tax, what you should do with taxes or not, but that is something you can consider. Yep. Okay. So let's look at another one here. Let's look at Microsoft. Again, it's a vertical spread. Again, it's one we're doing fairly well on. Notice, as soon as we roll it out, it resets that PL open on those. Okay. Microsoft, we're doing fairly well on this. Let's look at Microsoft. This is a short call vertical. So it's a bearish trade. Are we still bearish? If we're not still bearish on it, maybe we just get out of it. Okay. Let's look at Microsoft. MSFT. Still bearish? Well, excuse me. Whether you're bearish or neutral, this kind of looks like maybe it's a little bit more neutral than anything. But that's okay for a short call vertical. What I can do is I can look to roll for a credit on this if I wanted to. And I could leave. I don't have to roll both legs. I can just look to roll one of the legs if I want. Just because right now, Microsoft is down at the 485 mark. 485. If I want to roll this, I could just look and I can click on create a rolling order. And you don't have to go out an extra week here. I'm going to keep this at the same expiration date, January 16th. Now, it's going to give me a little error message. It's going to say you can't have the same, it's the same thing. It's not doing anything. Well, I'm going to look to roll this down a little bit here. And so we can go to the 495. That would give me a $145 credit there if I did that. And let's just see what strikes are available here. Let's see, I think we're on January 16th. Yep, there we go. Let's look at our calls. And you can always kind of just get an idea of the roll value that you're looking at. This is our current position, okay, right here. We're talking about the short leg right now. This is the short position. If I roll this down to 497.50, the difference between the price of this contract and this contract is going to be the amount of credit we get. If I roll it down to 495, I get a bigger credit. But I'm also taking in more risk for 2 reasons. One, it's problematic for 2 reasons. One, I'm widening the spread between my long leg, which is 505, and my short leg, which, if we did it, would be 495. That's a $10 spread. That gives me more potential risk. Additionally, it changes the probabilities of it. It's more likely that the current stock price, which is 485, is going to go above 495 than it's going to go above 497.50 or 500. So you just got to weigh it. there's not a right or wrong answer here on this. You can use delta as kind of a guide of probabilities if you want. Delta tells us how much the option is going to move in relationship to a $1 move in the stock price, but it can also give us an idea on probabilities. I'm just going to nudge this down just a little bit to bring in the credit. It's still most likely, according to the probabilities at least, going to expire out of the money. Okay, so about a 28% chance if you use delta as a guide, which isn't perfect, but it gives us a sense, about a 28% chance of it going in the money. So here's what I'm going to do. I'm going to roll this. I'm going to make this a 497.50. Let's see what credit we bring in. It's going to give us about a $67 credit on this times 3 contracts on that. So we're going to roll that guy out, and a day or good chance, doesn't matter. I'm going to go just off the mid price a little bit. Confirm and send. Send. We just rolled that, and there we go. Okay, so, and what is it? It's showing this was the old one, and here's the new one, okay? And when you roll, what it does is, just so you're always aware, I always want you to be aware of this, it zeroes out the new P&L. We had a nice profit showing on this, right? This was a very nice profit we had. Well, now it's showing as a huge loss. That's why that PL open is not always indicative of the bigger picture, because we didn't roll this one out. This is the one we were showing a loss on, but we reset the good one that was showing, I don't know, $1,500 or so. So that's why you cannot rely on P&L open for the bigger picture on that trade. Okay, if you have any questions, let me know. Between Ben and myself, we'll do our best to help you out on those. Okay, so there's a couple rolls here. Now, let's look at another one, trying to illustrate this, and maybe or maybe not rolling. Here's Apple. Apple's a trade that, frankly, is not going so great right now. We're down a little bit on it, on this trade. This is a short put vertical, which means we're bullish on this. Are we still bullish on Apple? That's always a question. Are we still bullish on Apple? Here's Apple. From a technical standpoint, I'm not super bullish here. For a while, we were dipping below our 20-day moving average, but not for long. We dipped below the 20-day moving average, and we've just kind of stayed there. And now we're right at that 50-day moving average. So looking a little less bullish on this. Do we take our lumps here, so to speak? Do we take a smaller loss and get out? We have 16 days to go to expiration. Our time decay is still positive. We still have positive theta on this, so time decay is helping us out. That would maybe push us in this to the direction of just kind of sticking with it a little bit. But now what I could do is I could roll this, if I wanted to, from 265. Well, let's look at it here. If we were to roll this, and we're going to consider the risk of what we do if we do this. Let me go to Apple. Let's look at the existing trade. Here we go. Here's the existing trade. If I were to stay in the same expiration, and I wanted to get a credit on this trade, I think I said 265, 270 is the short leg here. I could roll this to a 272.50. Okay, I could do that. It would bring in a credit, but what's the downside? You always have to consider your risks on rolling. What is the downside? The downside, if I roll this for that credit, and the credit's going to be, we'll say roughly $100 credit. Sounds good. But I'm also doing two things. I'm changing the total risk on the trade. So instead of a $5 wide spread, which is where we start the overall risk equation from, we would be increasing it to a $7.50 wide spread. So we're increasing the total risk, and we're also going to do something that Zach brings up in the chat. The probabilities change too. If we roll this from a 270, which is a little bit out of the money, to a 272.50, that's basically almost exactly where the stock is right now. Look at our delta. Basically, it becomes a coin flip almost in terms of, are we above it or below it at expiration? So in this case, weighing all the factors, although that $100 credit sounds nice little New Year's gift, so to speak, I'm going to say no to the roll, and I could either stick with it, or what I'm going to do here in this case is I'm going to get out of this trade. I'm going to take our loss on this, that $80 loss, and I'm going to get out of this. So I'm going to create a closing order to buy it back. Now, when you create that roll, whenever you do an order on a spread here on the Thinkorswim desktop platform, it's going to default to the mid price. Getting filled at the mid price can be a challenge. You can put it at the mid price and then it's likely not going to fill immediately. In real money, at least, maybe in paper money. But if you wait a little bit, the price may move up or down as the stock moves up or down. But what you can do is you can go, well, look, I'm going to go just a little bit off the mid. I'm going to go between the mid and the natural. Now, if I put it in the natural, I'll probably get filled right away, even in live, the live platform. If I go halfway, that's, then it becomes more iffy. The reality is, in paper money, you probably just need to move it up a little bit, just a smidge, and you'll likely get filled. That's what I've found. In other words, if I go off the mid price, which is 131 to 132, I'll probably get filled in paper money. This is no guarantee. I would expect probably that in a live platform, that would not actually get filled right away. Okay. I don't know. We'll do that. I'm going to confirm and send, and I'm going to send that to close that out. Now, remember, if we do have something that we're closing out, or if we're rolling, because really rolling is the same as closing out and opening a new trade. We're just doing it in one order ticket. If you're doing either of those, if you have a stop loss, you need to get out of that stop loss. You need to adjust the stop loss, because the stop loss was on the old contracts. Okay, so we did BMY, we did Microsoft. Let's look at a different trade. Let's look at a different type of trade. How about, okay? Let's go to, that's not right. What do I want here? What am I looking for? Trying to remember what. There was another one I wanted to. Let's look at Coke. We'll try and get to a bunch of these, but I had an order on these. And what do I have here? This looks kind of like a vertical, doesn't it? 77, no, same strike, different expirations. Okay, same strike, different expirations. What kind of trade is that? Okay. Yeah, that's a calendar spread, right? It's a calendar spread. So same strike, different expirations, calendar spread. Now, here's the thing on this. And now, in the chat, we have, could we have converted it to an iron condor? Yeah, I didn't go through that just because, there's a lot of different possibilities. You have a short vertical, for example, and maybe it's kind of going against you. You can throw in addition to a short put vertical, you could throw in a short call vertical on there, make it an iron condor. Here's the key. on these. When you're considering converting to an iron condor or rolling to a new trade or whatever, the key is view it almost as if it's a new trade entirely. What would you do if it were a new trade? Forget the history. History it's a sunk deal. It's sunk cost. Consider it from as a new trade perspective. Would you enter this trade? And if the answer is yes, then yeah, consider doing that iron condor or consider rolling it. But if the answer is, on Apple, maybe I'm not looking bullish enough on that. Maybe we just get out. We just get out in that case then. So good question. I'm glad you brought that up. Now let's look at Coke. We've got a calendar. And when we talk about managing calendars, there's a few things we do typically. When we talk about managing calendars. One is we say, if the stock goes against you totally, a technical breakout down, we're going to get out of it. In other words, the calendar is kind of a neutralist trade. If it starts to look very bullish or very bearish, we're probably just going to say, look, I was wrong. I thought it was going to be neutral. It's not. I'm going to get out. Okay, try and cut our losses. Another thing is when the short leg gets under about 10 days or so, we're going to look to roll it out. Well, we're not there quite yet on this. And another situation, a good situation, if you will, is if your strike prices and your stock price are basically the same. Because on a calendar spread, remember what the profit loss looks like on a calendar spread, the risk reward, the profit loss graph? It looks kind of like this on a calendar spread. And that peak, that's that expiration, but at that peak, that's where the strike price is. Well, we're on the strike price, okay? Now, ideally, this can certainly get a lot better. There's no doubt on this. In fact, if we were to look at the Analyze tab on Coke, let me pull that up, what you'll see is, well, we haven't made as nearly as much as we can. Well, that's the frustrating thing on calendars, everybody, to be very honest. The frustrating thing is they're really slow-moving trades typically. And you just got to wait for time decay to do its thing. There's a big difference between where we're at now and at expiration. If we were right at expiration, things would be great. We'd be right at basically max gain at that point. Well, we have a small gain. And you go, well, that's kind of a disappointing gain. In fact, it's even less than what it was earlier today. It's showing $11. It's not much. Okay. That's calendars for you. The good news on that is when calendars move against you, they typically don't show huge losses quickly either. I can't make any guarantees on that, but typically calendars are slow moving either for you or against you. But often what we'll do is we'll roll out when the stock price and the strike price are basically the same thing. So I'm going to do that. I'm going to look at this. I'm going to roll out. I'm going to roll it and I'm going to roll it out a little bit. I'm going to try and go out to something that's a little bit closer to the expiration of the long was 51. This is 16 days to go to expiration. So let's just look at Coke and see what we can get for a credit here. Here's our current position on Coke, roughly 190, okay, 190. If I go out, let me just get fewer strikes to make it a little easier. If I go out a couple weeks, I don't have the choice of going, wait a second, sorry. Here's our current position. That makes more sense. And I go out 2 weeks to 30 days. What's our roll value going to be? Well, I'm looking at the $70 strike, and I'll just take the mid price here. It's about $1.20, okay? Right now, this is at about 85 cents. What's the difference between those? The difference between $1.25 and $1.20 and $1.85 is about 35 cents, if I'm doing my math right there. That gives me a roll of about a $35 credit on that. So that's kind of gives you that idea. Go to January 30th. Let's look at that as a roll. I'm not going to roll both. I'm just rolling this one. So I'm just going to highlight this one. I'm just going to right click on this one. I'm going to create a rolling order. It's only going to give me one choice. Now, if I click on the whole thing and I click on create rolling order, it's going to say, yeah, I want to do the whole calendar. Well, I don't want to do the whole calendar spread. I just want to do this one here. Okay, what do I do? Rolling. I want to do this, and it's going to automatically put me out to the next strike. I'm going to go out the next expiration. I'm going to go out 2 expirations there. There's my $36 credit on this that we're doing. We're keeping the trade essentially the same, but we're just kind of moving the strikes out. We still want Coke to be neutral. If our trade, if we're not neutral on it, if all of a sudden we say, this looks bearish or this looks bullish, then we probably would not roll this out at this point, okay? We look to just get out of it, but I'm going to assume we're kind of neutral on this. And I'm going to go here and I'm going to confirm and send, and I'm going to send that order there, okay? And I went through that a little quickly. Realize whenever you have that order confirmation dialog box here, make sure you read it. Read the whole thing, okay? Make sure you read that whole thing. I went through that a little quicker than I should have, but just make sure you read. Okay, let's check on time. How are we doing? Okay, we got time. We're doing good here. Let's do another one, different type of trade entirely. I want to go to WBD, okay, WBD. Warner Brothers Discovery. This has been in the news a lot lately because of these bids to buy them or their assets. What is this? This is a long call, okay? When did we get in this? We got in this on the 25th of November. Okay, fair enough. We're doing pretty well on this, as you can see. And we are, we're at 16 days. Now, a lot of times on trades, we say, wait till it gets to be about a week out or so. But this is a long call. And remember, with a long call, you have negative thetas. Time decay works against you on long calls. Now, I think a lot of you are aware of this, but if you think of an option and you think of, here's the expiration date of an option, and this is a measure of theta, okay? Here's a measure of theta. At theta, as you get closer to expiration, in fact, this isn't really that was a terrible drawing because that makes it look more linear than anything. Let me try this again. Here's expiration. Here's theta. And then theta really ramps up as you get closer to expiration. Okay? So here's, I'm just going to, this is not scientific here. This is just kind of a schematic here. Here's a month till expiration. You start to see that theta really kind of ramp up. Now, is it ramping up a little bit before a month? Yeah, it sure is. But then it tends to accelerate. Here, we're a couple weeks till expiration on this. So one advantage of rolling out would be to lower the theta a little bit. But also, on this, I've got to decide, am I still bullish on it? Because 16 days, we're kind of getting near the expiration date on this, right? So if I go to WBD and I say, well, I think it's had its run, I'm not going to continue with this anymore, then you get out, okay? Now we have a stop on it. I'm going to have to do something with that stop if I do roll it. But if I do want to extend this, am I still bullish? Well, technical analysis, perhaps. Trend has been going up. It's bounced off that 20-day in the past. Is it going to bounce again? I don't know, but for what it's worth, the technicals seem relatively strong right now. It's no guarantee of the future. but I'm going to roll this out. I'm going to extend this out, and I'm going to have to adjust the stop because, of course, if I extend this out, say from January to February or something, this is a trend trade. It's not a long-term trade. But if I extend this out to February, I still have a stop based on this January contract. So I'm going to cancel this out. I can click on it. I can right click there and I can just cancel that order. Okay. I no longer have a stop on this. But what I'm going to do is I'm going to look to roll this out. So what do we roll it out to? Well, what did I say before? I said we're going to roll it out to kind of like what we would roll it out to if we were just looking at the trade with fresh eyes, so to speak. Right now, it's a 22 strike, okay? But if I roll from there to expiring in 16 days to something farther, let's go 37 days, okay? Let's just see what we got. I'm going to look at my delta, and I'm going to go in the money on the long call a little bit. We'll go to, say, a 65 delta. Not a lot of liquidity here on this. That's a pretty big bid-ask spread. Let's look at the open interest on this. Not much. You can probably see why. I suspect we'll go 51 days. It's going to be more expensive to roll out 51 days, but you can see that open interest is a lot more and the liquidity is a lot better. So let me just look at my delta again. I'm going to go in the money, 65 delta. Yeah, that's looking a lot better. I'm going to go to the 28 strike, February 20th. Okay, February 20th, 28 strike. Let's click on this. I'm going to right click on this. I'm going to create a rolling order. I'm going to go to February 20th. I'm going to go to the 28 strike. I'll be very curious to see what this is. Okay, it's a credit. Why is it a credit? How am I getting a credit on this if I'm buying more time? Because think about this for a sec. If I buy more time, as you get further out in time, options become more expensive. But look, I'm rolling it not just out, but I'm rolling the strike up to a higher strike. Why? Because Warner Brothers has done so well. I'm able to bring in a credit, take some money off the table, so to speak, and roll out at the same time. Okay, so that's a nice $460 credit. We'll do that. Okay, I'm going to roll that. And then what I'm going to do is I'm going to do this first. And then what I'm going to do is I'm going to put in a new stop. Okay. So let's confirm and send. Make sure you read it through. Make sure it makes sense for you. And then we're going to click send. Okay. Now let's look at WBD. Here we go. Here's our new trade. If I want to add a stop to this, I can right click on it. I can create a closing order. And I can do this based on the underlying stock price, which we often do in this webcast. You can do it based on the option price as well. I'm going to put, this is a stop, and let me go here to my, I just want to show you something here. Here's my current position. Mark is about 180 on this. Let me go back to my trade. I don't want my stop at 175. I mean, that sounds great because I want to, it may trigger quick, but it would probably trigger in 5 minutes perhaps. So I'm not going to do a 180 stop. I'm going to go down and I'm going to do a little bit over 50%, but less than 75%. So I'm going to do put my stop at 120. I'm going to make that good till canceled. And I'm going to confirm and send, and I'm going to send that order. Okay, there we go. We've adjusted that. We've adjusted the stop as well. Okay, there's one other trade I want to do today. Okay, and what did I do? Did I just somehow I messed that up? Okay, well, let's do that. Let's look and see what I did, because I just got rid of my call. I messed that up. Let's see what we got. Okay, Warner Brothers. Oh, price, filled orders. I sold that. I bought it. I sold it. Hold on one sec. Let's just do a little investigative history here. 120 limit. Oh, I didn't change it to a stop, everybody. Yes. Oh, Chris says limit order. Okay. Well, that's a little embarrassing. I got to admit, I did not change that to a stop order. You guys see what I did? I did not change it to a stop order. It got filled because it was at a limit order. Limit order says sell at that price or above, not if we go down to that price. So that's what I did. So, okay, that's what I get for being too quick about this. Okay, so let's redo this trade. We're going to enter a call. I'm going to copy this. Will that let me copy that trade? Okay. Warner Brothers, February 20th, 28 call. February 20th, 28 call. I'm going to right click on this, buy custom with a stop. I'm going to make this is a stop this time. I'm going to make it good till canceled. We're going to buy this. We're going to put our stop in at 120. I'm going a little quicker just because I want to make sure I got this here. And let me just, that should fill. I think we're going to put this in our long single options. And there we go. Okay. So now we have our new trade there. And here it is. Okay. That's what it's supposed to look like. Okay. Let's finish up with Nike. Nike, we look at it each week. What we've been doing is we've just been rolling and rolling and rolling each, probably every couple weeks or so as Nike went down and brought in credits along the way. Well, what did Nike do? Nike's actually reversing itself. There was some news on Nike that their CEO, I think, has bought a bunch of shares. Even Tim Cook, who's a director of the company, Tim Cook of Apple, has bought some shares too. That's giving the nice spike here. Here's the problem. The problem is we rolled this, and for a change, our short contract actually isn't doing well. And so what if I were to roll this out? I could roll this out if I wanted to, and we may not do this, but I just want to show you. Let's look at the current. We currently have this $63 call. What if we roll this? What if we roll this $63 call out a week? Basically, we could actually get a credit on this if we rolled it out. Same strike, 63. We'd be selling this one. I'm just going to put a little minus sign. This is our existing one. Maybe credit, maybe break even roughly. So why wouldn't we do that and kind of wipe out the loss or bring in a credit or something on that? Well, there's pros and cons, but keep in mind there's risk that we've talked about earlier today of risking of changing the strike price and adjusting the total risk on the trade. Okay, that's one risk. There's a risk of changing probabilities. That's another risk. This is kind of a risk of time. This is giving it more time if I do this, an extra week for it to go against us and get worse. Okay, so that's just a final risk. I'm out of time here on this, but that's a final risk to consider. When you roll things out in time, you're giving things more time to maybe work for you, but also maybe work against you. Sometimes that can be I think, an important consideration. All right, I'm not going to roll this today. We'll look at this again in the future, maybe next week. But for now, that's it. Happy New Year, everybody. Thanks for joining me and Ben today. Thanks for joining us, not just today, but throughout the year. And we look forward to a wonderful 2026. I hope you personally have a wonderful 2026 as well. We'll see you next week. Bye-bye.